If you're an investor, you've probably seen the scary headlines. In late 2025, job cuts in the United States surpassed 1 million for the year. 1 million. Amazon cut 14,000 jobs. UPS laid off workers. Microsoft terminated people with no severance. And these aren't struggling companies. The US economy is growing and the stock market just hit all-time highs. So why are successful companies firing people at scale? But here's the reframe, and this is what the headlines missed. The trigger isn't a recession. The answer is AI. And if you think this is just a US problem, you're missing the single biggest shift affecting your portfolio. Every mega-cap tech firm you own in your ETFs, Meta, Microsoft, Google, Amazon, is at the center of this. This is a far more complex story than just layoffs, and it will define market winners and losers for the next decade. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Brokers 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through the 1 million job cull and answer why AI-driven layoffs are the most important new trend for Singapore and Malaysian investors. First, let's break down the real drivers. The layoff surge isn't just one thing, it's a collision of three realities. The first driver is, of course, economic uncertainty. We saw the US labor market slow dramatically. The Federal Reserve even cut rates by 0.05 percentage points in October 2025 and signaled more cuts are coming. They are clearly worried. When companies see these cloudy conditions, they go into a defensive crouch. They cut optionality, and optionality is just corporate speak for people. The second driver was government dysfunction. A federal government shutdown began on October 1st, 2025. This halted the release of critical economic data. The monthly jobs report was delayed. Weekly unemployment claims stopped. In this fog of uncertainty, businesses either freeze or get aggressive. Many chose aggressive, preemptive cuts. But the third driver is the most important one, the one that's permanent. That is operational pressure and the relentless adoption of AI. Rising costs, margin compression, and the promise of AI automation created a perfect storm. Companies finally realized they could do more with fewer people and do it faster. Amazon's leadership didn't even hide this. They said the cuts would make the company leaner and help them innovate much faster. For us as investors, this is the crucial nuance. This is code for we are shedding human layers to move at machine speed. This isn't just a cyclical recession layoff. This is a permanent structural change. And it's not just about firing people. It's about reshuffling the entire deck. So on our next slide, let's look at the jobs getting axed and why this is creating a new wage trap. First, let's define what's being cut. The data is brutal. Over 80% of Amazon's initial layoffs hit retail-facing functions, e-commerce operations, human resources, and logistics. Now, let's analyze this. What do these roles have in common? They are process-driven. If your job involves following a process, analyzing standardized data, or managing routine tasks, AI is coming for you. Entry-level workers and mid-management are getting hit hardest because their work is the most automatable. This leads to a painful new reality I call the wage polarization trap. Companies are shedding these mid-tier roles while hiring desperately for AI-adjacent positions. AI engineers now command 2 to 3 times the premium over a routine software developer. AI product managers and even AI ethics officers are earning significantly more. Here's Iggy's perspective on this. This polarization widens inequality, and we have hard data on it. Black unemployment in the US just hit a 4-year high of 7.2%, signaling that these structural cuts hit the most vulnerable populations first. For us in Singapore, this matters because many of our multinational firms hire from here into global roles. If your career is in routine analytics or standard support, your global market wage is now under intense pressure. If you're in AI strategy, your wage is accelerating. This isn't a temporary blip. It's the new shape of the labor market. This leads us to our third critical point, why consumer spending and the markets could crack. Let's define the connection. It's simple. Layoffs reduce income. Lower income means less spending. Less spending means lower retail sales and a direct hit to the consumer discretionary stocks many of us hold. Now let's analyze the full impact. It's not just the 1 million people who were laid off. It's what we call the Great Freeze. Companies aren't just firing, they're also slowing hiring, promotions, and raises significantly. This widespread job insecurity chills consumer confidence. People who fear job loss cut their spending too. Add to that the secondary shock from the government shutdown. About 200,000 probationary federal workers facing uncertain employment. And you have a massive new crowd of cautious consumers. Here's Iggy's perspective for our portfolios. This is a direct warning signal for our home base investments. For Singapore investors, a wobbly American consumer is a direct threat. It hits the global profit engines we own, but more specifically, it's a headwind for S-REITs that have heavy US or European commercial and retail exposure. What we must track now are the Q4 2025 earnings guidance from consumer-facing firms. If retailers miss their numbers, it's a sign these AI-driven job losses are hitting consumer wallets harder than the market is pricing in. That is your signal to trim discretionary exposure and rotate into value. But this is not a simple doom and gloom story. And this brings us to our fourth and most important slide, the AI reshuffling, or what I call the talent remix. Let's define this concept. This is not simple downsizing. It is a fundamental restructuring with a clear purpose. Let's analyze the actions of these companies. Meta laid off 5% of its staff, but simultaneously committed to backfilling many roles and went on an aggressive AI hiring spree. Microsoft cut jobs but maintained its overall headcount by bringing in new AI-focused hires. This is a deliberate portfolio reallocation of human capital. Gartner analyst Nate Suda defined this perfectly. He said companies are shedding roles whose economic value has fallen below the AI line, while doubling down on new roles that monetize the very same technology. In other words, firms are moving capital from human expense streams that AI can replace into human expense streams that drive AI revenue. So what roles are being backfilled? AI product development, machine learning engineering, data science, AI ethics and compliance, complex customer experience design. Here's Iggy's perspective. This is the single most critical trend for us as tech investors. The mega-cap US giants that anchor your SRS portfolio are being rebuilt, restructured, and re-engineered around AI. Their future earnings, their margins, and their stock price growth will be driven by these new AI-adjacent revenue streams. Our job as analysts is no longer just to look at their old software or advertising businesses. It is to identify which of these firms can execute this talent remix the best. The ones who do it well will outperform for the next decade. The ones who fail will be left behind. This transition, however, is not smooth. Our fifth slide looks at the skills crisis and the confidence gap it's creating. First, the skills crisis. Business leaders are panicking. A damning statistic just came out. 55% of business leaders already regret making employees redundant when adopting AI. They fired people too fast and lost critical institutional knowledge. Worse, 30% admit they weren't clear on which roles were even at risk. And yet, 80% now say they have plans to reskill employees. The problem? AI skills are evolving 66% faster than non-AI skills. And that's 2.5 times faster than last year. Training programs cannot keep up. Now, let's pair this with the confidence gap. A striking survey found that 60% of AI experts at universities have little to no confidence that private companies will develop and use AI responsibly. Meanwhile, only 39% of experts inside those tech companies share that concern. Here's Iggy's perspective on what this means for investors. This mess creates both a huge risk and a huge opportunity. The opportunity is in the picks and shovels of this new gold rush, the edtech companies. Platforms that teach AI skills, Coursera, Udemy, and local Singaporean coding boot camps will see exploding demand. This is a high-growth theme. The risk is that confidence gap. If regulators and the public lose faith in big tech's ability to self-govern, political pressure will build. We're already seeing it with Europe's AI Act. Tighter regulation compresses margins. Investors must start tracking which firms are building trustworthy AI and which are cutting corners. Finally, let's look at the policy responses and the extreme scenarios. The US government response is frankly a fragmented patchwork. At the federal level, the White House announced America's AI Action Plan, which positions AI as a national priority. The focus is on innovation and winning the global AI race, not restriction. But at the state level, it's a different story. California is leading with Senate Bill 942, the AI Transparency Act, which mandates disclosure for AI-generated content. Multiple states are also trying to regulate bossware, that intrusive software that tracks employee productivity. This patchwork adds compliance complexity and costs. But then there's the extreme long-term scenario. Max Tegmark from the Future of Life Institute raises a radical concern. He argues that if AI leads to superintelligence, the question isn't whether 50% of jobs vanish, but whether 100% of jobs become redundant. Here's Iggy's perspective. The state-by-state regulation is a medium-term margin risk we need to watch. The superintelligence idea, while it sounds like science fiction, reinforces a core investment principle. You must own assets. If labor becomes decoupled from wealth, asset ownership, real estate, equities, bonds is the only thing that determines your destiny. This isn't a reason to panic, but it is a powerful reason to diversify your capital and not rely 100% on your human capital or your job. So, let's pull this all together in Iggy's assessment. The 2025 layoff surge is real. 1 million cuts is a material number, but it's not chaos. It's creative destruction. What's working, or the big opportunity, is clear. The AI leaders, the Amazons, Microsofts, Googles, and Nvidias are actively restructuring to expand their margins. They are capturing the value from this AI revolution. This is the growth engine for your portfolio. What's not working, or the key risk, is twofold. First, the AI vulnerables, companies with high routine work, mid-tier consultancies, and non-AI-centric software will see their margins compress. Second, the wobbly US consumer is a direct headwind for our dividend portfolios, specifically S-REITs with heavy US or European commercial exposure. The valuation gap between the AI leaders and the AI vulnerables is going to widen, and you must be on the right side of that trade. This brings us to the final recommendation. This new reality demands a two-part playbook. Win the US reshuffle and reinforce your local home base. So for existing unit holders and stockholders, your job right now is to re-audit your portfolio. Do you own the AI leaders or the AI vulnerables? In your SRS account, which is built for growth, you let those leaders run. But in your CPF and cash portfolio, your job is defense. You must stress test your S-REITs. You must demand to know if our local banks, DBS, OCBC, and UOB, are using AI to defend their margins or if they are just sitting still. And for new buyers looking to deploy capital, this is not a time to buy the tech dip broadly. You must be ruthless. Your growth capital should go into the AI leaders who are actively driving this change. For your dividend portfolio, you must look for resilience. This could mean rotating out of US exposed REITs and into heartland Singaporean retail REITs, which are insulated by local demand, and identifying the local banks that are most vocal and aggressive about their own AI strategy. This is the beginning of a decade-long restructuring. The winners won't just be those who bought the right US tech stock. They will be the investors who understood how that wave impacts every single asset, from a US ETF all the way down to a local Singaporean bank. Don't be flat-footed. Know what you own and why you own it in this new AI-driven world. If you found this analysis valuable and want to go deeper than the headlines, consider becoming a free or paid subscriber to the Investing Iguana's Substack newsletter. It's where we publish all our long-form research first. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 15 paid Substack members who make this in-depth, independent research possible. Thanks for watching, and I'll see you in the next analysis.